We start today's market talk. Intellectual humility means saying, I am not sure. This is an essential trait for investors because if we admit to uncertainty, we will investigate before we invest, double check our conclusions, and proceed with caution. There is no place for certainty in fields that are influenced by psychological fluctuations, irrationality, and randomness. Okay, so market outlook. The most important event next week is going to be budget. So budget should strike a balance between fiscal consolidation, capex, and a push to consumption. The tax buoyancy and the RBI dividend are expected to give the government enough leeway to do all three. That is my opinion. This is the first budget in third term. It provides an ideal platform, not just to outline the government's plan for achieving objective of Viksit Bharat, but also to put a timeline to it, because it is all the good things are already articulated, but it is now time to walk the talk, give some specific timelines. Vision is known, but the execution is the key issue. This FM has never been populist and has set new standards of transparency by bringing off-budget spending into the budget estimates. So we'll have to see the fine print. Improvement in outlook for agriculture and revival of rural spending has turned out to be the bright spots in the evolution of demand conditions. This has come out of RBI State of Economy report, which says that second quarter of FY25 has begun with quickening of momentum in the economy. Fiscal discipline translates into fiscal stimulus for all sections of the economy through lower interest rates. Budget should prune fiscal deficit, do reforms, and create conditions for private sector to flourish. Upmove from here is contingent on continued support to capex, fillip to manufacturing, and make in India. Credible plans for sustained job creation, lifting the sagging consumer sentiment, and addressing rural distress. Market will track the capital expenditure, which was 11.1 lakh crore, as was the BE in interim budget, and the railway capex, which was 2.65 lakh crore. So market will watch for these two numbers, and in case there is a upgradation of these numbers, then it will be appreciated. China plus one will be seen through PLI prism, because it is expected the government will announce some PLI in labor-intensive industries like textiles. There may be, for taxation part, there may be increase in standard deduction, increase in slab of taxable income, whatever, something will be there. And there would be allocation to schemes like Manrega, Jal Jeevan, National Health Mission, PM Kisan, PM Awas Yojana, etc., which will be watched, and all will have an impact. Now, Make in India especially is important because it is very critical for sectors like chemicals, green energy, for electric vehicles. FAME subsidies need to be restarted, and electronic manufacturing services, which is the high growth sector right now in the economy. For allocation to defense capital expenditure to maintain the momentum on indigenization, and the capex for rail modernization will be important. Government recently issued fifth positive indigenization list of 346 products and systems that would be procured domestically. Defense exports reached 1,000 crore in FY23-24, that is last year. Coming to railways, the EPC companies like Aircon, RVNL, companies providing railway security, lighting, Kavach, trains, metros, engines, coaches, etc. will benefit if there is more investment planned. And this is one of the most important key result area of the government. Now, markets certainly are not looking at any tweak in the capital gain structure, although there is a fear of restriction on derivative trading. So most likely thing, in my opinion, is STT hike for FNO segment, which in case it is substantial will result in change in strategies for trading, because then you can only do fewer adjustments. But we'll have to see the fine print now. Okay. Now coming to US, their markets posted the worst week since mid-April. due to rotation out of mega tech stocks due to CPI, the consumer inflation report. Data on CPI followed June non-farm payroll report that showed slowing job growth and an upstick in unemployment. Investors are moving out of tech names into value and small cap stocks. And then there is a Trump trade, which is based on tax cuts, protectionist trade policies, lesser focus on climate change, etc. Fed chair said that inflation is moving towards 2% and they may not wait for it to reach 2%. And because of that, the bond yields came down. But now, after this change in narrative, again with the Trump thing happening, they bounce back up. So we'll have to see this trajectory right now. Right now, the trend is it is trending downwards. And initially, the dollar index was correcting, and it had corrected, but then it bounced back after the Trump's press conference, where it has bounced back now. It has come to the 50 EMA. So it has bounced back because he is talking about things which are, may strengthen the dollar. Brent crude has come down and has come down to 81 level because hurricane season has not been that bad and Middle East issues are generally okay, and Russia-Ukraine thing is also not really firing up. Gold, it had gone up on the rate cut hopes, but then it has corrected from around 2,500 levels and has come down to 2,400 levels. So we'll have to watch this space, but it remains bullish. Copper has corrected and has come to on the weekly chart, has come to the 20 EMA. So beyond a level, higher prices of copper are not sustainable. So that long-term bull run in copper, etc., I don't think it is correct. And there are, the moment the prices of a commodity go up, people start finding alternate replacements for them. So S&P 500, it had a big red candle. It corrected around 1.97%, similar to the April correction, which was pretty big. So after a series of green candles, it has corrected. Now India VIX, there's a weekly chart. Predictably, it had come down to around 12.5 level, and then it went back. This is normal because of the results season and the upcoming budget. So it is now poised just below the 20 EMA. So need to be watched. But it is not shot up that much that one has to be worried. The government bond yields came down. It has come down to 6.96, which should have helped the PSU banks, but I don't think so. It is happening, so they are correcting. Now this is Nifty weekly chart. So if you see, Nifty went up for most of the week and then got knocked out on Friday, and it made a inverted hammer, which implies there is a big possibility of a change in the trend. Now, if you see here, this inverted hammer, red hammer, has followed three green candles, each one smaller than the previous one. So it shows that the buying momentum was reducing, but we'll have to watch. Though the Nifty had made a fresh all-time high this week, roughly around 24,850. So we'll have to see where it goes from here. Now, if you see the daily chart, we had 4 trading days. 2 days was basically dojis. Nothing much happened. And then Nifty broke out on Thursday. And then on Friday, it made a bearish engulfing candle, which literally has engulfed the moment in the whole week. So it is down to the same level where it started from. It also broke the previous day's low and closed lower. So that should be a sign of worry. So unless and until this 24,850 is not crossed, the momentum should not be back. In my opinion, Monday will be a quiet day with some downward bias because people will be not taking positions or would be hoping for budget clarity. Uh, Valuations, as I brought out in the current market, are supported due to liquidity and sentiment. FIs are aggressive with their longs, and SIP flow is strong. So the risk, if budget announcements is actually the risk is if budget announcements impact liquidity flow to the markets. That is the risk, because right now it is these valuations supported by liquidity. So if the anything in the budget which impacts liquidity, it will impact the sentiment. So one next week one has to be cautious. Now I'll show you the support. So this is the 30 minutes chart on Nifty. So if you see this, this is the first swing low, which it has touched now already at 24,500. The next swing low is at 24,150 odd. So that should be the level to, in case this level breaks. So that should be provide the support, because in generally the second swing low provides support in the short term. Now coming to Nifty Bank, similarly it was weak. It had made similarly on the weekly chart. It made a inverted hammer, so it is looking weak, and one has to watch this space. If you see the daily chart again, 2 red days, 2 green days, and it has come to 20 EMA. So this 52,050 odd level would be critical. If this breaks, then a trip down to 51,000 is likely. Results are mixed right now, so there is no clear direction which is coming out, but they are not that overwhelming that they should really power the bank Nifty up. And since Nifty Bank has around 35% stake in the or weightage in the Nifty, so that drags the Nifty also. The problem is HDFC Bank. So if you see the weekly chart, it made a third low, third red candle last week. And in my opinion, this range of 1600 to 1630 is the critical zone. It should remain in this zone now from here, because there is no incremental negative news as such. Most of the negative news is in the price now. So this, for at least for next 2-3 weeks, it should remain in this till the time that new money which comes in because of MSCI rebalancing, etc. Reliance, it made a high and then it has broken down, but this level of 3,030 odd should provide support. But it made a big red candle last few days. So and the results are also not that great. So it should be. It should test this support, and if this breaks, then the next level should be 2960. The surprising part was that in a environment just before the budget, the ITC is going up. So it has really shot up and has reached around 480 odd levels. So it will test this 500 levels, which was its previous high. And once this breaks, then it may head another 10% from here. This is a clear breakout for ITC and consumption. So if the government gives more money to rural consumption, etc., so then this should be beneficial, because this is relatively cheaper among the FMCG stocks also. Nifty IT was the clear winner. I had told last week that it is breaking out, so it has broken out and made a fresh high. So it is now at around 40,000 level, which is ahead of its previous high. So because the results, especially of the large caps, were slightly better than expectation, it is not yet on the weekly chart. It is not yet overbought. So there is some more upside is possible. Midcap index, it was going into overbought territory and it has corrected, made a big red candle. So it has come down to the levels 2 weeks back. So we'll have to see from here. If this level breaks, then it will test the 4th June levels of around 54,000 and below. Small cap index, similarly, it had corrected and has come down to the same level of 2 weeks back. And now, if it corrects a little bit more, then it will test this 18,000 level and then the 20 EMA. So this has to be watched. I'll cover a few stocks today. Again, these are relatively safer stocks. That's why I'm covering them. First is Muthoot Finance. The reason is because this is a direct play on rise in gold prices, and loan growth in gold loans is got direct correlation to gold price movement. So if the gold prices go up, these gold loan providers do well. Other advantage to Muthoot Finance is because there is a problem with IFL Finance till now, so which has not yet been resolved fully. So this is it will have a good quarter. It's the largest gold NBFC. AUM roughly 75,800 crore with a strong gold financing franchise and healthy operating metrics. With gold loan mix at 82% of consolidated AUM, it offers better leverage to gold prices, tailwind, market share gain opportunity versus peers. So that is one advantage which Muthoot Finance has over the other gold finances, is because they are more focused on gold loans as compared to other loans. Being largely a pure play gold NBFC, asset quality risk are lower as versus most peers. It offers mainly gold loans with maximum tenure of up to 12 months to small businesses and salaried individuals. It has incentivized monthly repayments in recent years to mitigate risk related to gold price movements. Because if the gold prices start going down, then people stop paying the EMIs. Strong loan CAGR of 17% is expected, 20% in FY25 and 30 versus 13% in FY21 to 24. So the loan CAGR has improved, which will drive 19% EPS CAGR and 19% plus ROE over the next 2-3 years. They have around 4,854 gold branches. This is basically a pure play South based franchise, but it is now going into other parts of the country also. It has the largest branch network versus peer gold NBFCs. It plans to add 100 to 150 branches per annum. Focus on diversification to other streams has lagged peers like Manappuram Gold Finance, but they have other issues because if you diversify, then your NPS goes up. Non-gold business accounts for 18% of its consolidated AUM and 13% of consolidated profit as of March 24. The non-gold subsidiary is called Belstar MFI. Microfinance, they give microfinance loans and has seen 40% CAGR in MFI loans in the last 5 years. So if let's see their AUM, present year is 758 billion, that is 75,800 crore, is expected to go up by around 20% next year and around 16 to 15% after that. Net profit is improving. EPS in FY26 is expected to be around 145, and ROA is strong at 5.3%. Now remember, a bank, best of the bank is around 2 return on assets. SBI is around, I think, 1, and some banks are below that. Now this is a key issue for them, which aids profits. ROA is pretty high. Price to book is FY26 should be around 2.2 and the present price. It can go higher, it can trade up to around 2.5, and PE is around 15 to 12 right now. The standalone loans to grow 17% CAGR over the next 3 years. So if you see, this is the present AUM, it is expected to reach 1 to 13 billion, that is 1,21,300 crores by FY27. They added 529 gold branches over last 6 years, and it is targeting 2 to 3% growth in branches per annum, which is good. With digitization, you can do higher amount of AUM per branch. Standalone asset quality is stable. So if you see here, the gross NPA is around 3.5 and net NPA is around 3.1. They don't have to do a lot of provisioning. So provisioning is lesser as compared to the banks and other people because they have a secured asset with them. So the provisioning is not required much. Hence, that is a lesser cost. Credit should stay in 18 to 19 basis point range over next three years. So credit cost of gross loans has come down now. As the interest rates are falling, so the credit cost should come down. So that is positive. Now let's see their EPS is expected to be around 145 in FY26, earning growth of around 20 to 18%, which is good. Book value is expected to be around 821. So at around 821, 2.5 times price to book, it should easily trade at 2000 plus from here. NIMs are very strong, around 11% plus, so which is very good. ROA, I have told you, is above 5%. ROA is 18 to 19%. AUM growth is around 15 to 16 odd percent now, and this year is expected to be FY25 around 20%. So, and it's got a dividend yield of 1.9 to 2%, so which is strong. So it's a safe stock to hold. Now, if you see here, it's had a steady rise, and it is now going up. So any dip from here up to 1700 levels is a good opportunity to get into this stock. So because this, you will tendency to lose money is less. It is slightly overbought as per RSI, but it's okay. It's in momentum right now. So just look out for this. Next stock is L&T Finance. What they have done is they have reoriented their business to retail. They were into a lot of other issues, but now they have reoriented to retail right now, which is now helping them. Retail AUM grew 31.4% year on year, driven by urban finance, microfinance, and two-wheeler finance. SME and loan against property, LAP loans grew the fastest. The wholesale book, however, plunged 70% year on year, owing to repayments and faster closures. Expect 19% loan CAGR over FY24 to 26, which is strong. Better yields are evident on the product mix, shifting to retail, driving NIMs to 9.3%. Changing product and customer mix strategy in favor of secured loans and prime customers was visible, with moderation in MFI disbursement growth and stronger growth in home loan, loan against property, and two-wheelers. Asset quality is better and lower credit cost. So let's see. This is their quarterly result. So if you see, their net interest income grew 20% year on year and 6% Q on Q. And their profit before tax was up 33% Q on Q and 29% year on year, which is pretty strong, though slightly below estimate, but still it is good. And net income has been growing. So this is in millions, so 685 crores. That is growth of 24% year on year and 29% year on year. 24% Q on Q and 29% year on year. And loan book is also growing decently, 4% Q on Q and 13% year on year, which is decent. Now let's see their future. So the net interest income is expected to grow around 15 to 20%. PAT is also expected to grow at around 20%. EPS is expected to be around 13 in FY26. NIMs are expected to be 9.3 odd. ROE is improving and is reaching around 12%. ROA is around 2.5. GNPA have come down, NPS, so to 3.2. And see price to book, it is at present price, it's approximately 1.4. So which is pretty decent right now. Let's see their ratios. Which I was talking about here, all ratios are improving as such. And book value is in FY26, presently it is 94. FY26 is expected to be 117. So it can easily trade at 2 times book to value. So it can be traded at around 230 to 34 as on date. Rest, if you see, the NIMs are improving. Cost to income is stable. Credit cost is stable. ROA is improving. ROE is improving. GS3 is the one which is more than NPA, which is more than 90 days late. Bad loan. So that is stable. I have come down a bit. Credit, Tier 1 ratio is strong. EPS is improving. So things are good and PE is coming down, so it is becoming less expensive. Now, if you see the disbursements here, uh, the rural business loans is the key part of their business. And if you see here, they have increased their retail loans every quarter and have reduced their wholesale loans and reduced even their microfinance loans because of the risk involved there. So they are focusing on two-wheeler loans, farm equipment loans, and rural business loans. So this is the key area, and home loans, which are relatively secure as compared to MFI loans, oblique SME finance, or something else. So that way, it is good that they are improving their book quality. Now, if you see the technicals, it has traded above 20 EMA, came down in March below that, but took support at 50 EMA, and then has bounced up after the results. But it has corrected. So, in my opinion, from here to 170 is a good opportunity to buy this stock for long term, because again the risk reward becomes favorable here. Uh, Next stock is Dixon. This is the key beneficiary of government's most successful PLI scheme. Uh, Mobile capacity is presently 45 million smartphones, that is 4.5 crore smartphones, and 40 million future phones can cater to 50% of the opportunity pool. Moreover, their agreement with HKC Corporation to manufacture display modules will further deepen value addition. 10% of BOM is bill of materials. It is basically what all constitute the product, ensuring customer stickiness. So they are increasing their content in as per for the BOM which is there in production, having acquired the controlling stake in Smarto brands like Itel, Infinix, Techno, along with partnership with Longchair, BBK Group brands, Realme, Oppo, Vivo, etc. It now caters to almost all the top 6 brands within the country. The ramp up of volumes with existing customers and new customer additions will help sustain the momentum in the mobile division, which is likely to contribute 75% of Dixon's incremental revenue over the next 3 years. So basically, it is a mobile player and which is trying to diversify into other streams. Government is working on introducing a PLI scheme for components with the target of increasing domestic value add to 35 to 40% initially, before increasing it further to 50% from the current 15 to 18%. So if you create an PLI so that the domestic value added to all these mobiles increases, so it will help improving their margins, and it will help improving their profits. And margins is the key issue here. So mobile phones are now among the top 5 export items in the country. They made around 1.5 crore mobile phones in FY24. So they are likely to make it to do it double in FY25. Now, if you see here, mobile exports have grown at 59% CAGR over the last 6-7 years. So you can see how imports have reduced and exports have gone up. 97% of the domestic needs are locally sourced. So the domestic production has improved, and so that means what? Domestic production is higher than the domestic demand. Hence, there is an export which is taking place. So this is in USD billion. So you can see 50 billion is the domestic production and 35 billion is the domestic demand. So you can judge as the size of the opportunity. Revenues are improving, and FY25 is expected to have 83% revenue growth from FY24. So it is going to have outstanding growth. EBITDA growth is expected to be around 79%. EBITDA margins are around 3.8, which is expected, but it is slightly improving, and with more value added, the margins will improve. PAT growth is expected at 99.6% from 367.8 crores to 734 crores, and it will become 1,000 crore and 1,300 crores over the next FY26 and FY26. So that is the EPS growth is around nearly 100% this year, and then around 34-35% over the next 2 years. So there is a lot of scope for growth. Now, if you see here, revenue-wise, the main part of the business is mobile and EMS. Rest, they are into consumer electronics, lighting products, home appliances, and security system. But the key is mobile and EMS, sorry, and which is going to remain so also. Is not going to change much. They will be incremental, but the key will remain mobiles and more partnership with the global players. Revenue growth is the maximum here, 124%, and balance are around double digits growth, which will continue. EBITDA, again, key a part of the EBITDA is coming from mobiles, and EBITDA margins, though home appliances is higher, but mobiles is larger, so that's why it keeps the total EBITDA at lower levels. So if they scale up their lighting products, home appliances, and other businesses, that should improve their margins. Now, if you see here, gross profit margins are around 9.4, EBITDA margins are around 3.8 for FY25, EBIT, and ROE is very high because of low equity base. So it's around 35, expected to be 35.9% in FY25 and continue like that. And ROIC is around, return on invested capital is 40%, and ROCE is around 48%. So they are able to do high ROE, hence their profits are improving because of their good cash flows. So they don't have to take much of debt or liquidate their equity. Revenue to grow at 46% CAGR over the next 3 years, which is very strong. Mobile and EMS to dominate revenue mix, which we have covered. So if you see, the mobile and the EMS division will be around 81%, around 75 to 80% over the next 2-3 years. EBITDA to grow at 45% CAGR and PAT to grow at 54% CAGR. Now let's see their chart. If you see here, from around in May, June, it was at around 8,000 levels, and it moved up for 50% in just 2-3 months, went to around 1,200, and now it had a big correction on Friday. So it's come down to 11,267 levels. So one can look to get it at around, in case it corrects to around 11,000, that should be a good level to enter, and anything below that to up to around 10,000, because this can move up also very quickly based on announcements in the budget. It had become overbought. The RSI had gone to above 80, and predictably it had to correct, so it has corrected. I have finished. We'll take questions now.